This week, what comes next in 2023 for reverse mortgage lending? Welcome back to the Industry Leader Update. To say the last 3 months have been tumultuous would be an understatement. And there are 3 factors that will be shaping 2023 reverse mortgage production: interest rates, lender contraction, and home values. Adapting to an adverse market will require an honest assessment of today's larger economic headwinds and a perspective that is rooted in indisputable fact. And that's what we're here to accomplish today. But first came a series of interest rate hikes by the Federal Reserve, which began in March 2022 with a modest 0.25% increase as the promise of transitory inflation began to fade. May brought a 50 basis point increase, followed by a series of 75 basis point or 0.75% increases in June, July, September, and November. While not tied directly to the target federal funds rate, those hikes naturally drove up the 10-year Constant Maturity Treasury rate, which is used to determine the available funds of the federally insured reverse mortgage, or the HECM. And as a result, the CMT index climbed from a low of 1.6% in January to 3.68%. And there was some improvement in the index in November, with the index falling from a high of 4.25% in late October. Federal Reserve Chairman Jerome Powell confirmed just last Wednesday that smaller interest rate increases are likely ahead beginning in December.
Shows only tentative signs of rebalancing, and wage growth remains well above levels that would be consistent with 2% inflation over time. So despite some promising developments, we have a long way to go in restoring price stability. Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level.
Powell made these remarks in a speech delivered before the Brookings Institution. The question is, what if inflation doesn't moderate? Then the Fed may be forced to return to more aggressive interest rate hikes. Next is lender contraction. Reverse mortgage funding announced their sudden cessation of reverse mortgage originations earlier this month, and last week brought the news of the lenders filing for Chapter 11 bankruptcy protection, which allows the company to continue operations while they reorganize their finances and work with creditors. RMF has been regularly ranked in the top 5 retail HECM lenders, if not the top 10 for some time, and generated just over 5,000 endorsements in fiscal year 2022. The impact on total HECM endorsements will be noticeable in February of next year as RMF submitted loans work their way through the pipeline and eventually stop. Over 400 employees were laid off last week, with many likely seeking employment opportunities with other reverse mortgage lenders. And the nation's largest lender, American Advisors Group, has also reduced their workforce, but they are continuing to originate reverse mortgage loans. Reverse Mortgage Daily reported on November 8th that AAG cut 204 jobs, most being retail field loan officers. And then the last factor is home values. The Fed's repeated interest rate reductions in the effort to stimulate an economy on its heels from the COVID-19 pandemic, that will have far-reaching repercussions. It was a potent combination of a tight housing inventory, then combined with extraordinarily low interest rates that created a rush of home buying activity, which drove up home values an average of 43% from the spring of 2020 until the market's height in June of this year. The Fed's repeated interest rate hikes had its intended effect. It cooled down an overheated housing market, a condition, by the way, which the central bank created in the first place. And affordability, that's the primary factor that's pushing down both home buying activity and listing prices. Market equilibrium will either require that home values come down or interest rates return to levels that make home buying possible for those that are currently priced out of the market. In conclusion, HECM endorsements are naturally going to see a significant drop throughout 2023. That due to fewer industry participants or lenders, interest rate pressure, which increases or actually decreases PLF factors, and softening home values. Now, unfortunately, this is the natural economic hangover after a 3-year bender of unchecked spending and artificial market conditions. However, while more difficult, lenders and originators who can hone their ability to uncover qualified homeowners in this most challenging market, they stand to gain market share as competitive pressures do recede. Now, what are your thoughts? Leave your comments in the comment section below. What are some of your observations maybe that we haven't covered on this show? We'd be most interested in hearing that. And if you'd be so kind as to share today's video on your LinkedIn and Facebook profiles, we always appreciate that. And don't forget to subscribe to our YouTube channel and hit the notification bell. And if you like today's episode and the effort we put into it, be sure to hit the like button as well. Each and every week, you can catch up on your reverse mortgage news. We have fresh stories for you every Monday on HECM World Weekly. Apple users can listen and subscribe on iTunes. Thanks for joining us again on the Industry Leader Update, and we will see you next week.